And our next guest sees more opportunity ahead in healthcare, utilities, and REITs, warning that some of the market's recent winners could be getting ahead of themselves. Janus Henderson Equities portfolio manager Jeremiah Buckley joins us now. He manages over $26 billion in assets. And Jeremiah, the sectors you like have not been the center of the action in terms of beneficiaries of the Trump trade. So are you sticking with them?
Yeah, that's correct. I think, we agree with the market that overall the results of the election are positive for equities going forward. But we disagree to some extent with some of the winners. We think some of them have gotten ahead of themselves. I think if you look at the banks, so far this year, banks are up over 40% with only 3% earnings growth in 2024. So I think that's one example. Certainly the outlook is positive. If we get changes in regulations and capital requirements, that certainly should be positive for banks. But I think the stocks are a bit ahead of themselves in that area of the market. Whereas if you look at other areas of the market like healthcare, we think the election results are also positive for healthcare. But that, I think, is tied with as the worst performing sector in the S&P 500 so far this year. And so we think there are some opportunities there. There's great R&D and innovation in healthcare. And so that's why we continue to be positive on that sector.
I am curious why you say you think the results of the election will be good for healthcare, because the market hasn't picked up on that yet, if it's true.
Yeah, so I think it's been a difficult regulatory environment for healthcare over the last 4 years with price controls on pharmaceuticals, regulations around Medicare and Medicaid. And so I don't think it gets worse from an environment standpoint. I think going forward, the administration could be a little more favorable for the overall industry, and that could be positive going forward.
Within healthcare, though, don't you have to be specific? Like the vaccine makers now, some are staying away from, worried about RFK Jr. and what his role might be.
Yeah, so I think there's great innovation. We've obviously seen the benefit of GLP-1s, which have driven substantial growth for pharmaceuticals and companies like Eli Lilly. We think there's additional innovation in cancer and across the board in diabetes, as well as medical devices. And so that's the innovation that we've been focused on. And we think healthcare services will have margin improvement over time as utilization trends kind of normalize. And so we think there are a number of factors outside of that will contribute to earnings growth for healthcare.
Do you have a strong view on rates? Because I notice you like utilities and REITs as well, which tend to move on what's happening in the bond market.
Yeah, so we think that rates will continue to tick lower over time. We think the Fed will continue on this cutting cycle, possibly at a more moderate pace, but they are clearly above the normal range at this point in time. And so we think over time that will be favorable for those rate-sensitive sectors. But it's not just a call on rates in our favoritism for utilities. It's a call on accelerating earnings growth over time. Obviously, with the electrification of the economy, that's going to benefit the utility players. We've seen a couple of companies in earnings season, XL and AEP, have raised their long-term earnings growth outlook and have had pretty aggressive CapEx plans as a result of this increased demand. And so we think it's both a combination of the potential for rates slowly coming down over time, as well as a better fundamental outlook for their growth over time.